Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. This week featured the Barclays Global Financial Services Conference, one of the more comprehensive and well-attended of all the financial conferences. I found the discussion with Jim Zelter, president of Apollo Global Management, particularly interesting, as he touched on a number of themes that are redefining the credit market landscape. Something he touched on that I found interesting was his take on what he characterized as a CapEx supercycle that we are in the midst of. Mr. Zelter points out that this cycle is being driven by investment-grade industries, tech and energy sustainability, as opposed to the last one, which was driven by non-investment-grade industries, cable, telecom, airlines, shale. All markets, public, private, bank, government, secured, unsecured, will play a role in meeting this massive financing need. Needless to say, we're already seeing the flow. This week, our three things are: 1. Credit's durability. Why has the asset class held up so well in 2025? 2. Risk concentrations. A couple are noteworthy and worth monitoring. And 3. Distressed debt exchanges. We highlight a new report by Ed Altman and our own Eric Rosenthal. All right, let's dig a bit deeper. Credit's durability. Through what has been a 2025 full of market drama, we remind investors that credit has held up relatively well. When the S&P sold off hard this past spring, down some 19% over the course of 2 months in response to the administration's tariff plan, the investment-grade index was down less than a point, while the high-yield index shed only 3%. Credit spreads widened 43 basis points out to 119 basis points, still well below the asset class's long-term average of 148 basis points. High-yield spreads widened 197 basis points out to essentially its long-term average before snapping back. It should be no great revelation that the equity sell-off reflected not only its subordination in the capital stack, but also the loftiness of the asset class's valuation. At its peak, just prior to the sell-off, the forward equity multiple in the S&P 500 was a breathtaking 22 times, a full 6 multiple points above its long-term average, and good enough to put the index's valuation at the time in the 99th percentile. In contrast, the credit indices, investment grade and high yield, were trading at just the 54th and 63rd percentiles, respectively. Credit's relative outperformance also speaks to investor perception that some portion of the risk introduced by the administration could be reversed quickly, say by pausing tariff enactment or allowing material carve-outs or by reaching agreement on some type of framework. And credit investors recognize that effective guardrails, such as markets, were in place to curb any of the administration's more ideological tendencies. Accordingly, we did not materially alter our recession probability or default rate forecasts as a result. But shareholders were seeing the same thing, so beyond the valuation differences, credit's outperformance in a weakening risk market speaks to where the asset class sits in the capital stack relative to shareholders. Whatever impact the administration's trade policy changes was to make to cash flows, to earnings, that threat poses less of a risk to a company's ability to repay principal and interest, especially for BB-rated credit and higher, than it poses to growth and margin, the underpinnings of the equity market. Not unlike factor investing in stocks, the opportunities today in credit are much broader than was the case 15 years ago due to developments in private markets and asset-backed technologies. Yes, credit delivers income and diversification, but it also can be defensive, as was demonstrated back in March and April. It can also be growth-sensitive and opportunistic, depending on what you're doing in credit. That's why the 60-40 portfolio is evolving into something that includes a meaningful allocation to alternatives. All right, on to our second thing, concentrations. So credit investors are schooled early on the evils of risk concentration. Don't put all your apples in one basket. Risk concentration heightens idiosyncratic risk and, in turn, volatility. One of the dominant themes in this bull market is concentration, often referenced in the stock market where a handful of stocks represent an historically disproportionate percentage of total market cap. The Mag 7, or 6, or 10. Apollo's Torsten Slok and team summarize it well. S&P 500 market cap concentration is extreme. S&P 500 returns concentration is extreme. S&P 500 earnings concentration is extreme. S&P 500 capex concentration is extreme. I think we get the point. Driving this, of course, is the development of artificial intelligence. Estimates suggest that investment in AI by the hyperscalers and everyone else in the first half accounted for as much as half of U.S. GDP growth. And picking up on our previous discussion, while that represents obvious risks to the equity market, should creditors, apart from those investing in those concentrated names and sectors, worry about this? The answer is, of course. Just how much you should worry is debatable. Taking just one data point as an example, we note that corporate earnings growth, the single most important factor underpinning every asset class in credit, is relatively healthy across the S&P 493, forecast to be around 5% in the second half of 2025, before accelerating to about 10% in the first half of 2026, according to consensus estimates compiled by FactSet. There's greater earnings weakness below the largest companies, as you would expect. To that point, more than 40% of the Russell 2000 is unprofitable. But overall, the power and durability of big tech means less to the overall health of the economy, as it employs roughly just 2% of U.S. workers, and supply chains have significant overseas elements. Still, creditors should worry about the wealth and sentiment effects of a possible sell-off in big tech, as was seen back in March and April, so we'll keep an eye on it. But that's not the only risk concentration out there. We also worry about the wealthiest households are accounting for a disproportionate amount of consumer spending. Historically, the rule of thumb has been that the top 20% of earners account for some 40% of consumer spending. Recent estimates suggest that the wealthiest cohort accounts for now more than half, as the wealth effect from rising stocks and real estate values fuels the ability and willingness of the wealthy to spend, while inflation and tighter credit and now diminishing job security are limiting spending among the middle and lower income segments. Acknowledging concentrations is all about tempering enthusiasm. Yes, broadening out equity market performance is a commonly held theme among investors today, and forecasts are for earnings dependence on big tech to reduce in 2026. But those concentrations in big tech, in AI, and in the spending prominence of the wealthiest households do present risks to be monitored and accounted for as we move forward. All right, on to our third thing, distressed debt exchanges. Joining me today is Eric Rosenthal from KBRA Analytics, who tracks defaults across broadly syndicated loans, high-yield bonds, and private credit. Eric generates our default forecast as part of his work with KBRA DLD, our direct lending news and analytical platform. Eric, along with our dear friend, NYU professor Ed Altman, recently published a paper examining the fate of distressed debt exchanges, aka DDEs. We encourage you to seek it out. Today, we'll highlight some of the key findings. Eric, welcome back to the podcast.
Thanks, Van. It's great to be back on the podcast, even if it means listening to how your Phillies have been embarrassing my Mets.
All right, so a little payback for the good guys. We had a rough trip to Queens a couple of weeks ago. Anyway, your paper examined the performance of 284 original DDEs in high yield and broadly syndicated loans from 2009 to 2022 to track their outcomes. What's the main takeaway?
Right. The original DDE functioned largely as a Band-Aid. Within 5 years, roughly half the sample suffered a second negative event, whether another DDE, a missed payment, or a bankruptcy. High yield stood out especially. More than 40% required another fix within just 24 months, and that share climbed to over 50% within 4 years. Broadly syndicated loan stats were a bit lower, with just over a quarter defaulting again within 2 years. However, by the 5-year mark, the figure rose to 43%.
All right, so you broke out the timing of second negative events in high yield into two periods, 2009 and 2015, and from 2016 to 2022. Were there any noticeable differences between the two?
Yes, nearly 60% of the 2016 to 2022 sample defaulted within 5 years, compared with less than 50% in the earlier period. Among the 2016 to 2022 sample, a second DDE was the most common outcome, though nearly 1 in 4 ultimately filed for bankruptcy. We considered making the same split for broadly syndicated loans, but the sample was too skewed towards recent activity. Since 2019, DDEs and broadly syndicated loans have become more common, comprising nearly half of loan default volume. That is up sharply from 8% during 2008 through 2018.
Do you think DDEs will continue to play a major role in liquid credit?
Absolutely. Year to date, DDEs account for 78% of BSL volume and 68% of high yield volume. These figures are very much in line with 2024. DDEs offer investors two main advantages. One, they are less costly than a bankruptcy process, and two, they provide time to turn around the business.
How about for direct lending?
Restructurings and distressed exits make up 79% of year-to-date volume. The direct lending market is not immune to relapses either. Walker Edison Furniture filed for bankruptcy in late August, about 2.5 years after its initial restructuring. Ideal Image Development is another example. After restructuring in the first quarter of 2024, it returned to the KBRA DLD default radar after landing on non-accrual last quarter. A few other names on our red list also appear positioned for another restructure.
Terrific. Thanks for that. Remind our listeners now where they can find your research.
Follow KBRA DLD on LinkedIn, and to receive our defaults weekly in your inbox or access all our reports on liquid credit and direct lending, contact Nikki Messino. Nikki.Messino@kbra.com.
Perfect. Thanks, Eric. So there you have it. 3 things in credit. 1, credit's durability. Reasonable valuations and up in the capital stack status keep the asset class well bid. 2, risk concentrations. Risk markets are perched on top of tech and the wealthiest households. And 3, distressed debt exchanges. Make sure you get a hold of the most recent study by Professor Ed Altman and our own Eric Rosenthal. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.